Hey there. A friend and I were talking the other day about the video I did last week where I did a modified ratio spread. And he suggested I do something simpler and maybe explain in more detail what I'm doing, why I'm doing it, what are options, just going back to very basic things. So I'm going to record this video in two parts. Tonight is the 27th of July. It is a Sunday evening, and I will record the trading part tomorrow and then edit the two pieces together and post it. So let's go over to a quick little presentation here and talk about just what are option contracts. So at a basic level, options are just contracts. They give the purchaser the right, but not necessarily the obligation to either buy or sell stock at a given price on or before a specific day. Now, there are two flavors of options, calls and puts. So the call option gives the buyer the right to buy the stock at a certain price. The put option gives the buyer the right to sell a stock at a specific price. But in general, we don't want to interact with the stock itself. We can open and close these contracts just by buying them or selling them. So if you have bought an option and you want to get out of the position, you just sell that contract. On the flip side, if you have sold an option, so you're short that contract and you want to get out of it, you would just buy it back. So ideally, we do not want to deal with the stock, but sometimes that's unavoidable, especially if you are the seller of a contract. So stock options are standardized. What's going to matter today for this video is that one option covers 100 shares of stock. So this causes some confusion sometimes with people who don't really trade a lot. When I say, for example, I made 30 cents on this trade, it means 30 cents per share of stock. So if it were on one option contract, it'd be 30 times 100, or 30 cents times 100, or $30. If it were 10 option contracts, it'd be 30 cents times 100 times 10, or what would that be, $300. So keep that in mind. So from now on, we'll be talking about put options. So as I mentioned earlier, put gives the buyer the right to sell the stock at the specified strike price on or before a given day. So why would someone wish to buy a put? Well, it could be a hedge. If you own a stock and you believe the stock is going to drop and you don't want to sell that stock outright, what you could do is buy a put. You pay a premium up front, of course, to buy the put, but if the stock goes down, that put will potentially cover your losses if it's on a one-to-one basis. Another reason, it could also be a speculative play. If you do not own the stock, what you could do is just buy the put, and the stock goes down, you could sell out the put and then make the profit. There's limited risk in this trade, so all you could lose is the amount you paid. So if you paid $5, or so remember, it's $5 per share, so it'd be $500 for a single contract. That's your maximum loss, and your potential gains are more or less unlimited. I mean, a stock can only go to zero, but if the stock drops 10 or 20%, you could stand to make a good chunk of money. What's the problem with that? Well, honestly, it's a low probability of success, and over time, I've found that buying options, you tend to lose money because, as we'll talk about in a bit, time is also a factor. So your option, if you don't get this big move right away, your option will decay in price as time progresses on. So the seller potentially incurs the obligation to buy the stock. So what are some of the characteristics of selling a put? Well, your max profit is limited to whatever that option premium was, whatever the buyer paid for it. So you have relatively small amount of money you can make. Another potential issue is the downside risk is big. Basically, you're taking on all the risk in the stead of the option purchaser. So if that stock drops big, you're on the hook for that. So why would anyone want to do that? Why would you sell a put? Well, basically, it's a very high probability trade. If you sell out of the money options, and we'll define what that means in a second, you have a good chance of making a profit. The key is going to be managing your risk, keeping your position small, not trading with too much leverage, not taking on too big of a position, not taking on too much risk in a specific underlying, or in cases where all your different trades are correlated to one another, so that if one goes down, all of them tend to go down, and you could lose big across several positions. So let us go on now to some definitions that we'll use, and then we'll switch over to the trading platform. So let's go on to some definitions here, and then in a second we'll switch over to the trading platform and talk about what this means in practice. So out of the money means that the option, the stock price, this is for puts by the way, the stock price is above the strike price of the option. And on the opposite side, for in the money, it simply means that the stock price is lower than the strike price. And for puts that are in the money, there's something called an intrinsic value, and that's simply the difference between the strike price and the current value of the stock. For a put that is out of the money, they have zero intrinsic value. Extrinsic value is everything that's left over, and you also hear the term time value instead of extrinsic value. And the last term that we'll probably use is delta. And for the sake of this video, I have videos on how to calculate delta elsewhere on this channel, but for the sake of this video, you can think of delta as the theoretical number of equivalent shares of that underlying stock. So if an option has, for example, 30 delta, it means you're long 30 shares of stock. And if it has minus 30 delta, it means you're theoretically short 30 shares of stock. And with options, those deltas change depending on what the price of the stock is. So for puts, long puts that you buy, they inherently have a negative delta. So it's like being short the stock. Conversely, if you are a put seller, a sold put, a short put has a positive delta and is theoretically similar to being long a certain number of shares of stock. So let's switch over now to the trading platform. We'll look at an Amazon trade for tomorrow morning, and we'll look to sell a put. So here we are in our trading platform. All of these numbers here are for Friday, because I'm recording this portion of the video on a Sunday. The futures markets are open, however. The E-mini S&P futures, where are they? They're down here. They're up 25 points. So some of these numbers that we're talking about now need to be adjusted, because the odds are, unless there's an overnight sell-off in the futures, that the market's going to open higher tomorrow. So let us go over to Amazon. Let's just type in AMZN, the ticker symbol for Amazon. In Tastyworks, you go to the Trade tab. And let me see, this has earnings coming up in a few days here at the end of July. Here are the dates of all the potential contracts you could do, and I'm going to go out to September because I trade options that are generally closest to 45 days to expiration. These ones above it here that are kind of that have the W here are weekly contracts that I generally don't trade. Occasionally I will, but I find that they're not as liquid as the main monthly contract. So I'm going to September. So we have calls on this left side, puts on the right side, and the stock is, at least it closed here, around $230. So let's go up to here, this line here. This option has a delta of what, about minus 14. So I'm going to sell the put, so that's 14 deltas. So if I click on the bid to sell it, I have an order window that comes up here. This option is going to trade, I mean, I don't know what it's going to trade for in the morning, so I might have to adjust this strike price, but it's roughly $2.10. So for a single contract, that would bring in a premium of $210. Now, Tasty, I don't generally use it because I've been doing this for a long time, but Tasty has this analysis tab that you can go to that's going to bring up this plot here. Let me close this slider here. This top line here gives you your potential profit and loss at the expiration of the contract, and this bottom line down here is at some intermediate time. I think it's currently set to 1 day. So for the sake of this, we'll ignore the bottom one and only look at this top one. So you can see at expiration, our theoretical P&L up here is a fixed number. It's going to be that $2.10 that we collect. So we start to get into trouble once we are significantly below the strike price, and you can see we start to lose money dollar for dollar with the decreasing stock price. So that's the risk of this trade here. A big down move and we'll start to lose a lot of money. If it stays above the strike price or goes higher, we will make money, but our profits are limited to that initial credit collected, in this case $2.60. So let us switch back to that grid view, the table view here. So this is the contract we're going to be interested in. I have my columns set up here that give the option delta and the probability of this option being in the money. So at the end of towards the end of September, what's the expiration date on here? September 19th. The probability that it's in the money as of this moment right now is only 15%. So I have an 85% chance of making some money on this. So 85% chance of making at least a penny. And down here, the platform also calculates the probability of making 50%. So in this case, $1.05 per share, and that's a lot higher of a probability, 93%. And that's generally when I like to exit my trades. So when I'm making a profit of roughly 50%. So I would close this at $1.05. Okay, it is now the 28th of July, 6:30 a.m., just a tad bit after that, Pacific time. So let's switch over to our trading platform. The market just opened. So here we are. The market did sell off a bit last night. It was up 25 when I recorded that previous video. It's now basically up 4, so basically unchanged. So the numbers that we were using yesterday are probably pretty good. So let's go to Amazon, AMZN. Let's actually type it right, AMZN. Go out to our September option chain, and we were looking at the 205 put. So Amazon, however, has moved up. So let's move our put up. We were looking at the 205 here. That credit is now down to 185. It was 210 as of the close Friday. So let's move it up to the 210 line here. It's trading at 250. Let's see, let's try to get 254 for it. So I'm going to try to get 254. The probability of it expiring out of the money or in the money is 18%. So we have a pretty good chance of making money on it. The probability of making 50% on it is still around 94%. So let's drop this price down a bit and route this trade. And we are filled. Excellent. So I hope you guys found this video educational. These trades that I'm doing here are for basically educational purposes. They're not really trading advice or trading recommendations, but I'm hoping you guys get something out of it. So if you have any questions, please feel free to leave them in the comments. I will, if I make any adjustments on this, what I will do, let's switch back to the main view here instead of this small little window. If I make any adjustments to this trade, what I will do is put them in a pinned comment attached to this video. So until next time, see ya.